Right. Um, Good evening, everyone. Greetings from Nairobi, Zambia, South Africa, and all over the place on this great and fine continent. Welcome to our webinar today on critical minerals and supply chains in Africa. My name is Rutendo Nyaku. I'm the Rule of Law Advisor at ALN Academy. And today our webinar is hosted in collaboration with the South African Institute of International Affairs. Next slide. The ALN Academy is a rule of law charity that's meant to promote the rule of law in Africa and enhances good governance across African countries by providing quality legal training, capacity building, and influencing and leading ideas on the discussions of the rule of law. Next slide. The South African Institute of International Affairs is an independent public policy think tank advancing a well-governed, peaceful, economically stable, sustainable, and globally engaged Africa. So we're really looking forward to their cross-regional perspectives. Do not be fooled by the name just South African Institute. We are going to be moderated by myself, but also Dominic Rebelo, who is a partner in the corporate department at ALN Kenya. He has broad experience spanning capital markets, mergers and acquisitions, fintech, energy and natural resources, and environmental law. He has played a significant role in significant mining and resource extraction matters, including advising the government of Kenya's Ministry of Mining alongside Slaughter and May on the development of the Mining Bill in 2014. So we're going to be hearing some very wonderful insights from Dominic. Also, one of the people who's going to be joining us as a speaker is Alex Benkenstein. He's the head of climate change and natural resource program at SAIIA, South African Institute of International Affairs. His work at SAIIA has focused on a number of resource governance related themes, particularly climate change, energy and just transition, extractive industry governance, and the sustainable blue economy. He's also conducted research in several African countries and has strong linkages with key regional institutions such as the African Union Commission and the Southern African Development Community. So welcome, Alex. We cannot wait to hear from you today. Our next speaker is Chris Green. Chris Green is a director at ALN Tanzania, and he has extensive experience in corporate and commercial law with a strong focus on cross-border mergers and acquisitions across sub-Saharan Africa. Recently, Chris acted for Anglo-American Marketing in a 10 million royalty agreement relating to Genmin's flagship Baniaka iron ore project in Gabon. So this is going to be very exciting. We also have Emmanuel Manda, who's the managing partner at ALN Zambia. He has extensive experience in corporate and commercial law, M&A, mining, as well as tax, and he has played a significant role in various mining transactions in which he has advised respective clients on all aspects of the transaction, and he has helped them navigate complex legal and tax issues in the extractive industry. And finally, we have Adrian Joseph, who is a research fellow at South African Institute of International Affairs, and his work focuses on critical minerals, specifically geopolitics, as it relates to the role of Africa's critical minerals in global energy transition. Before SAIIA, he was working at the Brenters Foundation as a Michelle Mandela Fellow and a former Konrad Adenauer Stiftung Scholar. So the youth demographic is well represented over here. So just a second to say welcome to all of our speakers, as well as my co-moderator, who is Dominic Rebelo in this moment. Next slide, please. We are here today to discuss pathways to sovereign value chains in Africa, and our main objectives are to unpack strategic relevance of Africa's critical minerals, reflect on the legal and investment trends, as well as promote various frameworks that will assist in mineral foresight, diplomacy, and governance. Next slide. The reason why we're also here is just really discussing critical minerals in Africa because of the position that they hold and the leverage that they have on the global front today. These minerals are useful for the energy transition and also for modern technology. Remember your cell phone. And they're critical, not just because of their physical properties, but because the demand for them is surging, supply chains are highly concentrated, and access is increasingly becoming geopoliticized. We typically find critical minerals in Africa. It's got a sort of broad geographical landscape. And some of the richest reserves that are in this continent are the cobalt, manganese, bauxite, graphite, nickel, and platinum group metals, hence why we have this nice geographical spread of speakers today speaking on these various issues. And the conversation is urgent for Africa today because Africa's minerals are indispensable to green growth globally. And yet the continent risks being a mere source of raw materials unless it actually captures more value downstream, and you'll hear more of that. In Zambia, we see a launch of the critical mineral strategy. In Zambia, we're seeing a mandated 20% of gold production. So these are just some examples of national responses that are emerging to answer some of these questions. And finally, there's the geopolitical aspect, which we cannot ignore. The European Union, the United States, and China are racing to secure access over these resources. And we have seen lots of partnerships and agreements being signed with sort of these regions. The risk is that Africa risks becoming a pawn unless it also starts to negotiate from a position of coordination and leverage. So we are really here to discuss what opportunities there are for Africa to leverage its own critical minerals and also to reposition its position in the global sphere. So Dominic, I will now hand over to you to take over the next section.
Thanks, Rotendo. So what we'll do to start is from my panelists, we'll have a quick 1 minute, 2 minutes on the topics we're going to delve into in more detail going forward. And Chris, maybe we can start with you. You've been practicing for a couple of decades now, South Africa, East Africa, and everywhere in between. Maybe you can give us a quick overview of the regulatory evolution in the regulatory environment that you've seen over the last few years.
Yeah, thanks, Dom. Thanks everyone for joining. It's a pleasure to be speaking to you. So I think it goes to Rotendo's introduction, and I think that the regulatory development in this part of the world, and by this part of the world, I'm referring specifically to where I have the most experience, and that's Southern and Eastern Africa. But I think it's more broadly reflected across the continent. Over the last 10 to 20 years, there's been a significant move away from the historical focus on extraction by multinational companies, exports of raw materials and processing abroad, to a regime, and there's often negative connotations with the term resource nationalization or nationalism, but I think in this context that's probably a good term, and refers to the jurisdictions in our part of the world having adopted far more robust regulatory frameworks to ensure sovereign ownership of mineral resources, to ensure local community participation in local resource and the economic benefits of those, and then more recently to facilitate in-country local beneficiation and value add to minerals rather than just being sources of extraction. And I think that nowhere can that move be better seen than in Tanzania. And I think that the evolution of the mining regulatory regime from around 2015 to today, so over the last 10 years, clearly demonstrates that move towards a heavy focus on local value addition to ensure that Tanzania and Tanzanians benefit from the country's mineral wealth rather than being a source of extraction. And that applies that's seen not only in mining legislation but across the kind of spectrum of regulatory reform, be that tax regulation, currency regulation, and the like. And I think that move is also in line with some of the broader regional policy regimes, and that, for example, under the African Mining Vision and the Green Mineral Strategy, all of which advocate for mineral beneficiation industrial policy alignment and regional cooperation. So Dom, let me stop there. I think that's kind of enough by way of intro, I think.
Yeah, thanks, Chris. So I think as we see those changes coming through, obviously mineral diplomacy becomes increasingly required. And Alex, you're obviously the expert on this. Maybe you can give us a few thoughts.
Yeah, absolutely. I think to pick up on what Chris mentioned there is to recognize as well that this moment is also kind of positioned within historical process, right? It's not a new thing, this push for local value addition and a link between mineral wealth and industrialization on the continent. We see this very clearly articulated in the African Mining Vision, which came out in 2009, but there were a number of policy debates kind of preceding that by many years that led to that main instrument. And I think one of the challenges that we need to grapple with is, if this has been an ambition of the continent for so long, why hasn't it happened? And that ties back to sort of minerals diplomacy that you asked about, Dominic. I mean, there are various hurdles. Part of it has been a race to the bottom and relative power. Investors simply saying, well, if you're going to make it difficult for us to get our minerals out of Tanzania or Zambia, there are other places that we can go to, global companies, global value chains. And that's been a real challenge. But this geostrategic competition, this geostrategic moment that Rutendo mentioned, I think does create a moment of leverage. And it's going to be very important to use that leverage wisely and look carefully at one's policy toolbox, carrots and sticks, around how you then pursue these objectives. There are some real constraints related to scale of production, infrastructure. One of the big challenges on the continent has simply been sufficient and reliable supply of energy for minerals processing. So this is not just a mining sector issue. This is a broader investment environment, industrial development, industrial policy issue, and it needs to be looked at cohesively.
Yeah, no, that's very true. It's not you can't do a one size fits all. And Emmanuel, I guess that turning to you in Zambia, with the copper there, been an ongoing debate for a while. Maybe you can give us some insights on how localization has been treated.
Okay, all right. Thanks, Dominic. Good afternoon, everyone, and thank you for having me on this webinar today. So if we're then looking at localization, I think I'll take a similar starting point to how Chris spoke about it, because what we've actually just had is a change in legislation. So we had the Mines and Minerals Development Act from 2015, which was repealed and replaced by the Minerals Regulation Commission Act in December 2024. And then on 13 June 2025, this new act actually commenced with the enactment of the commencement order. So when we're then looking at the regulatory changes which have actually occurred, what we've actually seen since the new government came into place in 2021 is a focus on the government actually getting more out of mining for the people, and then also trying to make sure that locals actually are able to benefit. So what we've then seen is, previously you'd have, let's say for instance, citizen influenced, citizen owned, and citizen empowered companies, which are 5% to 51% owned by citizens, were entitled to actually hold areas between 6 hectares to 400.8 hectares. But then with the new act which has come into effect, this area size has actually been increased from 6.6 hectares to 1,000 hectares. And then also from the previous act, there was actually an emphasis on mining entities actually having a local business development plan, and then ensuring that they're able to access Zambian goods and services for purposes of their operations. And then now with this act which has come into effect, the government has been speaking about beneficiation and value addition to minerals And what we've actually seen is that there's now a particular section which empowers a minister to actually enact regulations which will actually speak to beneficiation and regulation. And then the government is also looking to finalize local content regulations, which will actually work hand in hand with this particular new act. And then also in looking at what role the government is trying to play, the government is actually trying to increase its stake and its involvement in the mining sector, because for so long there's been a public complaint that the government hasn't actually been involved, because it's been having a minimum 20% stake, and this is a stake which has been there since privatization. But then now what we're seeing is the government actually taking a stand and then saying they want percentages as high as 49% in certain entities, and then also asking for royalties instead of having to wait for a dividend to be declared before we can actually derive a return from mining entities. So I think that's sort of the shift in the landscape and how we're trying to keep most of the benefit here as opposed to it leaving the country.
You know, those kind of legal shifts where you have a whole change in the law. If we look at countries in East Africa, in the last 10 years, pretty much all of them have overhauled their mining jurisprudence at some point. And a lot of it has pushed, exactly like you said, Emmanuel, towards this more local beneficiation. And changing laws, well, obviously required, keeping up with the times, etc., in general is bad for business, because you tend to see investors holding back, they wait to see what happens, etc. And yet, despite that, we've seen quite a big push across the continent in the M&A space. So it's not just new assets coming online, but it's increasingly investment into existing assets. And we'll talk about this a bit more further in a few minutes. But a lot of that is shifting from investment in the M&A space to, investment through the M&A space, from the extraction to the beneficiation projects. And increasingly, some of it is purely aimed at the beneficiation, whether pushed by domestic requirements or by the higher value that can be gained there. A lot of it, though, was also from the ESG requirements. And Adrian, I know you're obviously our ESG expert, so maybe you can tell us a bit about what you think where we're looking at as more and more robust ESG frameworks are imposed upon companies operating in the region.
Thank you, Dominic, and thank you for the invitation. Yes, what I would say is that I agree with the previous speakers that yes, there's been a shift towards a greater desire for value addition within country. But at the same time, there's also a recognition amongst African policymakers and others that mining this time has to be different, in the sense that mining and refining that takes place has to be done in a way that benefits local communities and protects the environment. Now, one of the challenges with this is that critical minerals tend to be concentrated in what are perceived as high-risk mining jurisdictions. And this makes it, this typically, apart from the sort of inherent challenges with implementing ESG within the mining sector, the sort of risk profiles of many of these mining jurisdictions compounds that challenge. It makes it more difficult to implement mining projects of the highest ESG standards. But what I will say is that you're seeing across different levels of policy that ESG with value addition, but ESG is also coming more to the fore. And I think what would be useful for me to do is to sort of talk about what are the different levels of policy making as they pertain to critical minerals. So at the multilateral level, we have the UN panel, which is working on critical energy transition minerals, and they've sort of laid out a set of guiding principles that are supposed to act as guardrails for the energy transition. Here again, concerns around ESG and sustainability have come to the fore. Then, as has already been mentioned, on the continental level, we have the African Green Mineral Strategy. I think it's important to note that the African Green Mineral Strategy is not a it's not a policy framework that's meant to replace the African mining vision. It's merely a complementary framework that's supposed to speak to the specific challenges and opportunities related to critical minerals, or green minerals, as the African Union refers to them. And one of the key pillars of that strategy is around social and environmental stewardship. And then to sort of come down to the national level, I mean, as has been mentioned, many countries across the continent are developing their own national policy frameworks around critical minerals. Just earlier this month, the South African government released its own critical mineral strategy, where once again there was recognition that from a private sector perspective, if mining companies want to establish a sustainable license to operate, they have to take proactive steps to ensure that mining operations do not harm the communities where the projects are taking place. So I think across the board, there's been quite a strong proliferation of various critical mineral strategies and policies, and I think the challenge is from a policy management side, how do you deal with this overwhelming resurgence in policy? So I think I'll just stop there for now.
Thanks, Adrian. So we've got this broadening of the ESG obligations and requirements, but underlying it, we've got a sector that is already inherently risky. The exploration and extraction itself is risky, and then you layer on top of that, like you said, a lot of these critical minerals are in areas where there is perceived, real or not, perceived political risk. There's land risk, there's community risk, there's currency risk, multiple risks, and nobody's going to put their money in unless they can de-risk as many of these as possible. Now, there's different ways of doing that through blended finance or political risk insurance, etc. But maybe, Chris, you can tell us what you've seen in some of the projects on the continent in terms of how you de-risk, especially some of that early stage risk.
Yeah, Dom, thanks. Again, I think it's an answer that has levels, not unlike the response that Adrian just gave. And I think it's not in not all respects unique to the mining sector. So I think at the outset, investors in the mining sector, and some of this is fairly rote, but it's important when structuring these projects to look at how you structure them from a jurisdictional perspective, to make sure that investors are taking advantage of things like structuring investment vehicles in jurisdictions with appropriate bilateral investment treaties, double tax agreements, and benefiting from the protection that those offer. Secondly, a lot of jurisdictions, Tanzania being an example, have national investment agencies who investors can work through in structuring their investments and their projects, not only to gain various financial incentives, but also to make sure that they're taking advantage of whatever investor protections are codified in those specific jurisdictions. You mentioned, Dom, in asking the question, you mentioned a couple of other things. I think increasingly important in the minerals extractive sector are things like blended finance models, where we have development finance institutions increasingly, I think, with an appetite to play catalytic roles in these energy, particularly energy-linked mining investments, and that speaks directly to the critical minerals aspects of what we're talking about. And then I think to leverage and make use of political risk insurance through institutions like MIGA and Africa Trade Insurance Agency. There are examples of projects which have already been covered in both Kenya and Tanzania through these agencies in relation to things like expropriation, breach of contract, and currency inconvertibility. And then I think the thing I would add last is, and I think this is often, maybe because of where we've come from, viewed by investors as a risk. But I think that in the context of discussing de-risking mining projects, I think investors increasingly are going to need to embrace the concept of state participation in mining projects and what that means for de-risking their projects. So if investors can adopt the mindset of having state participation in mining projects as a de-risking strategy, and engage in those discussions with governments, and negotiate the framework agreements in such a manner that they obtain benefits from them in the process of entering into those arrangements, I think that those can play significant roles in de-risking these investments and projects.
And in terms of de-risking the ESG side of it, I mean, I guess you could look at it through a similar lens. If you've got government in as a shareholder on your project, and the ESG requirements are being imposed on you predominantly by the government, then you also help to de-risk from that perspective as well.
Yeah, I think that's right, Dom. And again, I think it's a kind of both and approach in these circumstances. So to the extent that you do embrace government as an investor, and that's your host government, and they're responsible for embedding ESG requirements in the legislation, I think that as a significant mining investor, you firstly can play a part in influencing what that policy framework looks like, or certainly how it's implemented. And I think you can take government along for that journey with you. And then I think that there are other aspects to how governments are increasingly needing to look at balancing, frankly, regulatory stability, which is, as we know, critical for any investor, with ever-evolving ESG demands, which Adrian and others are certainly more qualified to speak to than what I am. But we see these not necessarily always in a coherent framework, but certainly as part of the matrix that these investments take place in. And for example, and I'm sure we'll talk more about it, but Tanzania has the concept of a use it or lose it type structure with respect to mining license, and ESG and environmental considerations form an important aspect of that now. And again, whilst that can sometimes be seen as restrictive from an investor's perspective, I think that the government has increasingly, certainly over the last 5 or so years, also become far more pragmatic in its approach, and coupled those requirements with increasing willingness to negotiate things like stabilization provisions, grandfathering provisions for projects which were established prior to changes in ESG frameworks, and those sorts of things. And I think that the combination of those things really helps to balance that regulatory need for regulatory stability with the evolving ESG demands that both governments and investors face.
Thanks, Chris. And maybe Manuel, turning to you on the balancing that Chris has just talked about. Given that Zambia's got this new legislation in place, how does it seek to do the balancing between bringing in the capital and keeping sovereignty within the country?
Okay, thanks for that, Dom. So I think what the government has been trying to do, and I'll just give a brief snapshot of, let's say, the landscape, and then the entities within which government actually has interests and would like to have interests in. So if we're then looking at the Zambian landscape, historically, their government has always had interests in the majority of the mines. So what you then find is that we have Mopani, which is 49% owned by ZCCMIH, which is the government's let me call it a quasi-governmental entity, which the government utilizes to invest in the mining sector in Zambia. And then it also holds interests in mines like Kansanshi mining and whatnot. So when we're then looking at how parties have tried to balance interests of, let's say, the state versus investors, what has tended to happen is that if you're looking at, let's say, coming in at exploration as opposed to entering a large-scale mining entity, then usually at exploration, you find that it's private entities who actually hold those large-scale exploration licenses. And then you then find major entities like, let's say, a Rio Tinto or whatnot, who are actually looking to partner with those local companies which hold these licenses. And then what they then do is that they agree to enter into an earning agreement with that particular entity. And then they fund the exploration which is being conducted on that exploration license, with hopes of then actually ending up mining. And this is when the exploration license is converted into a large-scale mining license. But then if you're then looking at it from a mining perspective, usually what you find is the government has its free carry interest, which is the 20% when the mines were privatized. And then they also additionally have a special share, which I think from all the old mines which we have, that special share has since lapsed, and which is held by the Minister of Finance. But then now what we've seen is, because in 2021, the government actually bought Mopani from Glencore, and then they owned it 100%. And then in 2023, they decided to auction it, and they called in, I think that should have been about 3 strategic equity partners to actually come in. So now when they then came in, the government, in trying to balance up the policy of the current regime, which is we need to get more from these mines and the people must benefit, what they then did was they said, okay, we need, instead of our historic 20%, you must give us up to 49%. And then in addition to the 49%, they then gave up their right to a dividend and then converted that to a royalty, which is then a percentage of the revenues of the entity, as opposed to waiting until the entity declares a dividend. And the reason why they then did this is because historically with one of the FQM entities, they've always had disputes around when a dividend is declared and when the government can actually get out money from there. And so FQM was then the first entity where this was done, and they then decided to adopt the same model for Mopani. And then they also said they could elect to have the royalty as well as the dividend right if they wish to. And so what then happens now is that when the investor is coming in, they actually have to look at the entity and actually look and say, okay, this is what the government wants. And because effectively the minerals are, for lack of a better term, the assets of the people, you then have to balance up what your interests are with regards to what the government actually wants. And then as Chris put it, the moment you have the government holding an increased interest, what you actually do is you de-risk the asset, because then even if you're looking at instances of non-compliance, it's unlikely that the government will move and act against itself, because effectively it is the government which is non-compliant. And so that's what we also saw with, let's say, an asset like Mopani, where they were non-compliant and deficient with their tax compliance, but then the government was not actually moving against it. And so now the thing which you then also see is when you're coming in, the government is also willing to clean up for you, and then you're also then able to start on a clean slate. So that's, I think, one way in which, let's say, the interests of the state as well as investors have been balanced up. And then once that is done, typically you then see that, let's say, the parties are able to get the finance, provided that if it's the investment agreement, shareholder agreement, and whatnot are put in place and negotiated and agreed with the government.
Thanks, Manu. Before we move on to capital inflows onto the continent in kind of the M&A scenarios, just one kind of million-dollar question, I guess, to Adrian and Alex. It's often touted that the Industrial Revolution pushed European Western development, and why should now new ESG requirements be imposed on Africa when we're at the point of just trying to get all these minerals out and benefit from them, etc.? Should we not be able to just develop as we can for the best for the people in each country? Do you think there's an actual opportunity to genuinely develop these resources and do it under modern ESG requirements?
I'll take a first stab at that and then hand over to Adrian. Yes, I think certainly. I've heard those arguments myself. Of course, the regulatory environment, our understanding of sustainability, the interface between the health of our environment and the health of our communities continues to evolve. So we are in a different space. Speaking as a South African, and it's perhaps a bit tricky in terms of where this messaging comes from, but I do worry about when we hear this opinion sometimes that environmental concerns or respect for the environment is somehow a foreign agenda that's imposed on the continent. I've spent enough time traveling around the continent to understand the appreciation of the interplay and the interdependence of environmental and social and economic prosperity on the continent. And I think that sort of narrative should be challenged. On the flip side, I would say that the other thing that I find sometimes concerning is that when you do find initiatives that are coming from, say, Europe or the US, other jurisdictions that focus on critical minerals, they do tend to emphasize ESG and underplay these priorities that are articulated on the continent around local value processing and links to industrialization. And, you know, you could look at that quite cynically and say that these partnerships are more interested in ensuring the unimpeded flow of clean minerals and cleaning up value chains that are predominantly positioned in other global economic centers, more so than they are in terms of serious partnership. So there's lots of dimensions that we can take to this, but I do think one's got to take a critical lens to a narrative that says that any environmental concerns are necessarily foreign to an African ambition or understanding. There are ways to manage this process, and the industry and our normative setting in which we are proceeding in this with minerals development is different. I mean, this is the fundamental idea behind frameworks like the Sustainable Development Goals, is that we are trying to find ways where economic, social, and environmental progress can proceed in tandem and don't have to be traded off against each other. Adrian, you maybe want to take that further.
Yes, I would just echo Alex's remarks to say that the major sort of frameworks, the major sort of foreign frameworks aimed at improving mineral governance on the continent and elsewhere, things like the EITI or the OECD's due diligence requirements, tend to focus, as Alex mentioned, they tend to have an emphasis on the supply security perspective, and they tend to underplay, I'm not sure whether intentionally or not, but they tend to underplay the sort of African ambition to foster local community development and value addition. So that's the one thing I'd say. I agree completely with Alex there. And then the second thing I would say is that it's important to understand that there is growing momentum behind the critical minerals debate, and there's a sense of urgency around our need to extract these minerals to support the global energy transition. However, that being said, we shouldn't allow this urgency around extracting critical minerals to allow us to sort of dilute or sidestep those requirements that are necessary for us to do mining responsibly. Because it's not a case of either or, as I mentioned earlier in my opening remarks. Good, sound ESG requirements are consistent with developing mining projects that benefit the investor and the local community. It's not only the right thing to do, it also makes business sense to maintain those standards. Yeah, that's what I'd say.
If I could maybe, Dominic, just quickly jump in again. The other dimension that I think we need to bring into this conversation is that we've been talking mostly about the investors and the state and the relationship between them. And sometimes we tend to conflate the state with the interests of the citizens of that state. But I think we must also recognize, not only in Africa, but across the world, that there often is a disconnect between the interests of local communities and the broader citizenry and the state that represents them. And so while it's very encouraging to see these sorts of emboldened moves in terms of regulatory innovation and more substantive partnerships, the kind of thing that Emmanuel is talking about happening in Zambia, we cannot then assume that just because the state is now entered into a partnership with investment or has larger shares within that investment, that they are then necessarily going to be representing the interests of those communities. In fact, you could very easily picture a scenario where that profit motive then drives state action as well at the cost of local community impact. So there is that dimension that we need to think about. We often talk about the social license to mine, the social compact. It's a bit of an intangible thing, but it is important to recognize that when we talk about ESG, it's not just a compliance issue. It's not just whether you're meeting those standards or whether anyone is holding you to account for meeting those standards. But it really speaks to a broader sense of trust within these core stakeholder groups.
Thanks, Alex. I think that's quite clear on that. I think it's really the balance between this relationship with ESG, the state, the private sector, who seems to be in the future going to be a continuing question. I think in terms of just getting some final thoughts on this section from Chris, perhaps you've got 1 or 2 minutes to just provide us with some final thoughts on this section.
Yeah, thanks, Rutendo. And I think to the point that Alex has just made, I mean, it's obviously important, and it's a key point for everyone to bear in mind. I do think, you know, how we look at that depends on how these regulatory frameworks do evolve and how they're approached by various governments. You know, in that respect, I think, you know, it's also important to look at some of the distinctions in what some of these frameworks look like, or components of them look like. So, you know, for example, in Tanzania, there's obviously a requirement that mining license holders, that government has a carried interest in respect of those projects. But you know, there's similarly several other requirements which relate directly to community benefits, local content in respect to procurement and interests of Tanzanians, and you know, the full spectrum of or the full life cycle of mining operations, from the mines themselves through to service providers, beneficiation. And again, I think, you know, I just wanted to make the point that it's an important discussion, again, with several layers, and something that investors will need to grapple with at multiple levels. I must also use the opportunity to apologize to everyone. I have double booked myself this evening, and I need to step away, but I leave you all in very capable hands. And again, thank you for having me.
Thanks, Chris. Thank you so much for those final words. I think what's really critical for us to take away here is that what needs to be continuous conversation is working out sort of fair benefits between, you know, the investor and what they're putting in and they're trying to get out, as well as what the state is trying to do in terms of allocating public goods to everyone, and obviously the communities that are going to be affected and are going to, you know, affected not just negatively but also positively in terms of jobs and, you know, what that kind of progress and development means. So I think working out and sequencing where those benefits are will just continue being a conversation that we'll have, and hopefully today we'll try to keep unpacking some of that. We're sort of moving on into the whys and the hows, specifically how M&A and investment deals are being structured across Africa's critical mineral sector, and whether those transactions are truly advancing the continent's value addition goals or simply reinforcing extractive patterns. So in this regard, I just want to firstly just open up the question to everyone. You know, perhaps maybe with Dom starting out. I mean, only 6 out of 40 countries with critical minerals have legally binding beneficiation quotas. And where they exist, uptake has been modest unless paired with tax-based incentives or guaranteed power infrastructure access. So what I want to find out from all of you panelists is, should the quotas be fixed, or should we be exploring graduated approaches that reward progressive compliance? I don't know, Dom, if you want to take a first stab at this, and we go around the room.
Yeah, sure. My thinking would always be that if you have it on a graduated scale, it's going to be better. Where we've seen mandatory in-country beneficiation, yes, it can work for some projects, but for others, And depending on the mineral, depending upon the size, depending upon what has to be put in, it's an impossible ask. And countries effectively are taking themselves off the market involuntarily by imposing it as a unilateral across all minerals. And so you find investors stepping back and saying, look, this just isn't going to work for us unless we can get an exemption from the government on the beneficiation side. We're not coming in on the exploration side. And so you do yourself out of everything. Now, if you have it on a graduated scale, or even better, as I think it's Namibia who's done it, where they have a percentage drop in royalties based upon the amount of beneficiation you do in country. So there's no mandatory you must beneficiate in country, but if you do, you'd pay a lower royalty on the basis that it's of a higher base. Then you're increasing the likelihood that money will flow in for those projects.
100%. Thank you, Dom. I don't know if Adrian, Alex.
Well, if I could jump in there, absolutely. So I mentioned in my opening statement this idea of kind of policy carrots and sticks, and these local beneficiation requirements can potentially be a very powerful stick that can be wielded. Now, I tend to agree with what Dominic has said, is that you need a graduated introduction because often the basic resources and infrastructure that you need for beneficiation simply isn't there. The risk, of course, is that this can come across as defending the status quo. And I think it is important to acknowledge and be very clear about the fact that we absolutely accept that the status quo is not something that we want to continue. It's about finding the most viable path towards these policy goals that have been articulated. There's another angle to this, though, and that is that when we look at some of these requirements in terms of local value addition, it typically is just the very first step down the value chain. So you're going from raw ore to first level concentrates, and then that meets those basic regulatory requirements, and typically you'll find that those concentrates then get exported in any event, mostly to China, because that's where the processing capacity is. But as Europe and the US increasingly compete with China, it's going to be going to other sources. The point is it's going out of the continent. And so I think what I've observed in some of these discussions is that there's this disconnect in the discussions, that where African stakeholders are talking about value addition and critical mineral value chains, you know, the ambition is to move eventually towards manufacturing components and, you know, batteries, solar panels, clean tech value chains, really at the high end of the value chain. Whereas if you look at what's happening on the ground and what is being labeled value addition and a win for beneficiation, it's often a very basic level of processing. Okay, that's better than we were, and that is something that should be celebrated. But I do think that this disconnect in narrative also needs to be brought into the discussion.
Thanks a lot, Alex. I think some of the points you raised, I'm seeing, are actually being discussed quite deeply within the Q&A section. You know, there's discussions right now on sort of, you know, the case for nationalization, with an example of Sahel countries and whether it's a solution to regain the benefits of critical minerals. And also, you know, whether there is an opportunity for localized mineral beneficiation. So I think some of the points you touched on kind of open up that conversation. And I don't know if Emmanuel has any thoughts and ideas about that, or Adrian.
Sorry, Rotenda, if I could just come in here. I just wanted to pick up on something from the previous discussion that was being said before we move on to the question. I think it's important that governments, African governments, have a long-term view, given the nature of mining, given, for example, the average lead time of a mine. And what we have seen in certain African countries is a kind of knee-jerk reaction to the market prices of certain critical minerals in terms of implementing export restrictions. Now, to Chris's earlier point, we must understand, we mustn't necessarily caricature these as resource nationalist policies, but we must understand where African policymakers are coming from. They're coming from this desire to ensure greater value addition, etc., etc. But that's why it's really important for countries to have a national strategy such that they have a long-term vision about what such arguably restrictive policy measures are meant to achieve. Because I think to Dominic's point, sometimes we talk about Africa's critical minerals. We speak about it in the aggregate. But I think the truth is really that there are certain producer countries who are already producing large amounts of critical minerals that's important for the global economy, who are in a position to implement certain policies that can foster greater value addition. So whatever the spectrum of policy measures that we take, I think it's really important that African governments pay attention to, okay, if we're going to implement an export restriction, should it be a blanket restriction, a tiered restriction? And then how does such industrial policy measures fit in with our national strategy in terms of answering the question of investors and communities in terms of how does the implementation of this policy measure benefit us or create greater value addition? So that's just what I wanted to add.
I'm glad you actually raised that point, Adrian, because I was just having a read about Zambia's new critical mineral strategy, which sets out a vision on increased state equity in deals, mandatory local value addition, public-private training hubs. So I think this question would be really great for Emmanuel to sort of jump in how Zambia is using M&A and joint ventures to promote local value addition and critical minerals. I think that will really allow us to get a sense of a foundation of what that could look like when we're thinking about sort of long-term policy and planning.
Okay, all right. Thanks for that, Rotendo. So I think something to just, point out with the Zambian critical mineral strategy is that for a while we've been speaking about value addition, and then also there have been proposals to actually reduce, let's say, the tax rate. So provided that you manufacture products from copper cathodes, then you then are entitled to a reduced tax rate of 20%, as opposed to the 30% standard corporate income tax rate, which applies to mines. But then if you're looking at it with regards to what has actually been happening in country, what has been happening on the ground, I would say that in effect, there has not actually been much value addition, and this been effectively, let's say, once minerals are extracted, they then leave the country, and that's that. And then because the mining companies are actually able to carry their losses forward for 10 years, you then find that at the end of the day, they're unlikely to pay any corporate income tax to the government. And then the only challenge which I would say we've had across the years has been inconsistent fiscal tax policies, because at one point, mineral royalty was not deductible for tax purposes. And then when this new government came in under their first budget, mineral royalties were then deductible. And then what we then also saw was a shift in how, let's say, the different governments were actually dealing with investors. Because if we're looking at our previous government, which was led by the late former president, they took, I would say, an aggressive mafia approach to dealing with investors. Because for them, they would get the investor across the table and then tell the investor, I want more out of this partnership with you. And then if the investor then says, okay, look, we don't think this entity is making money and we can't actually declare a dividend now, then what they would then do is they would effectively, and this is an example of Konkola Copper Mines and what happened with it, where they put the company in liquidation, but the main issue was that the government actually wanted to derive more out of it. And so what you then saw at that point was we were slightly aggressive with how we're dealing with our approach with, let's say, with investors. And so what then happened was interest in our mining sector actually waned, because then people were looking at it and saying that happened to Konkola, and then Glencore also left us with a huge debt. And then with a change in government, and from 2021 till now, the approach has sort of been, we can partner with you, but then what we want is a higher stake. And then also we want guaranteed income. We don't want to wait until you say, okay, we can have a dividend, and then it's a tiny portion which we get. What we want is actually guaranteed income. And then also what you then see is, and I think it was Alex who may have mentioned it, and I agreed with his point where he said it's not necessarily that what the government says actually reflects, let's say, the will of the people. And so when you also look at, like the example I gave on Mopani, yes, quite all right, on paper, we have a 49% stake using the government's SAIIA. But then if you actually speak to people who actually live on the copper belt where the mine is, everyone is then questioning and asking, what is the benefit which has actually come to the community from this particular project? Because yes, there are those conditions where you must utilize the services of locals for particular goods and services which the mine needs. But then everyone around is asking and saying, how are we benefiting from this mine, which you've given up the 51%? And then how is that actually an actual partnership? And then the reason why we also ask these questions is because when you're looking at, let's say, the current state of our government, we defaulted in 2020 during COVID. And then after we defaulted, we've then been on a 3 to 4 year debt restructuring program with all our lenders. And then only now is when we're approaching the end of that. And so now it's a question of, if we have 49%, if there's funding which we need to put in, do we actually have the capacity to put in that funding? And I think this goes also to one of the questions which was asked, saying, is resource nationalization a solution to our critical minerals, I would say, crisis or strategy in Africa? I would say, if I'm looking at it from a Zambian perspective, the current state of, let's say, the country, our capacity to actually run these huge mines, be able to put in the capex which is needed, I would say at this point, no, we are not ready for it at this particular point. And also, if we look at beneficiation and value addition, again, it's the same thing where what we're trying to do is adopt what's happening in the region and trying to see how that will work for us. And if we're looking at how I think it should work, I would agree with Dom and say, I think a graduated scale is something which we may actually see some gains with this. But then if it was not graduated, then I don't think we might see some gains. But then if we're looking now at how is the government actually balancing it, I would say is, one is increased stakes, and then also the government is reserving specific areas in which only the government established SPV will be able to hold licenses in that particular area. And then if you as an investor actually want a license from that specific area, you actually need to partner with the government. And then in the previous rendition of this new act, the government was actually supposed to have a fixed stake through exploration, and then it would maintain that stake once the exploration license is converted to a mining license. But then that has now been done away with, and what we understand is that the free carry interest which the government will now want to hold will actually be contractual between the investor as well as the government. And then the other thing which government is, I think, willing to do is they can give you the majority of the board, and then, but the only thing which they would want is, let's say, the royalty which I've spoken about, and then increased revenue from this particular stream.
Thanks, Emmanuel. I think before I just launch into the next question, Alex, I think you had a point.
Yeah, I'd also like to take a stab at this nationalization question. So, I actually wrote just a second, excuse me. Sorry. I actually wrote my thesis many, many years ago, master's thesis, on this question of, this trend that we've seen towards, that historical moment in the 50s and 60s, early 70s, when there was a strong movement towards nationalization, national ownership, and then the kind of switch back during the 80s and 90s. Critics of governments and nationally owned mines are going to have plenty of examples where this has not worked. And critics of a private sector-led model are also going to have plenty of examples where mining investments have not resulted in significant benefit to the host country, and has resulted in negative impacts, environmental and social impacts in that environment. I don't think there's any one right or wrong answer. Fundamentally, if you look at what the research has been telling us, and there's been a lot of research done over many decades on this question, it comes down to governance and the regulatory environment, and what systems of transparency and accountability you set up to ensure that the resources and the benefits of those resources do accrue to the state in sufficient form, and do ultimately benefit communities themselves. I've heard it more and more recently in discussions around mining in Africa, where you'd have community groups or even policy officials saying, but who owns the minerals? How is it possible? And the implication is that it's foreign companies or foreigners that own Africa's minerals. The minerals are owned by the state. The state is the custodian of the mineral wealth of the country. They license companies, whether it's a state-owned company or a private company or some sort of partnership, to license those mines. I think it's a little bit of a red herring, this question of ownership. I think we need to ask ourselves where the resources are going and how those governance principles that there's increasing consensus around what those are: transparency, accountability, strong institutions. You know, it's the quality of the governance that's ultimately going to determine benefits.
Thanks a lot for that, Alex. It just means, Dominic, you've got quite a number of things coming on your plate. I think we've really spoken critically on, what the state's sort of responsibility is as a custodian, but also we're really trying to balance, where the national and community interests are. And I know in some, article that you've recently worked on with Chris showed that over 50% of mining-related M&A in Africa between 2018 and 2023 involved foreign acquirers. Yet in most of these deals, local communities remained absent from revenue-sharing frameworks. And it also stated that these states held minimal governance rights post-transaction. And so when we're looking at this balance of the state, of looking at sort of the investor who's putting in all of this money in this deal, I have two questions for you, which are, what deal structures then can prioritize national and community interests? And which of these structures are actually proving effective from your vantage point in advising deals? And where are the gaps in the implementation?
Yeah, thanks, Tendo. I think we've talked about most of them, in terms of the free carried interest of government being probably the best option. You do see governments sometimes having requirements for locally held equity or mandatory local joint ventures. Ghana, I think, has that, but that's very hard to make it work where you need a local partner for these kind of size of investments. You also see sometimes local listing requirements, which are in the law but rarely enforced for exactly the same reason. You don't have capital markets with a relevant liquidity, and you don't have capital markets that have the depth or expertise to take on the risk, especially of an exploration project. You get that in more developed jurisdictions like Canada, Australia, etc. But I don't think there's anywhere on the continent that has capital markets of that nature yet. We talked about the progressive royalties, which really seems to be the other one, in addition to the free carried government interest. But some more subtle ones that we sometimes see working are things like requirements to give preference to local suppliers, local employment, etc. And some countries, Kenya, for example, we have an obligation separate from our mining law in our community land law, which gives a right of co-ownership over minerals to the communities, meaning that separate from your mining legislation, if you're dealing with minerals which are on community land, you have to bring the community along with you, and you have to give them bring them along with a community development agreement that sets out what the local community will get, separate from the county and the national government. The problem with all of them, though, I think, is that the monitoring and enforcement is always tricky. And unless you've got a genuine monitoring enforcement, then it's very hard to know whether there's compliance or not. And you get, a lot of gray around the edges, so to speak, as to whether it's actually happening or not.
100%. Adrian, any last thoughts on your side? What are some trends you're noticing in this regard?
I mean, I think what I'd say is that the comments that Dominic made also apply to the South African case, where there are mines are required to permit SLPs to demonstrate how the mine being in the community will benefit the community. And one of the challenges has simply just been around lack of implementation. And this is a common challenge with governments across the board, in the sense of it's okay to have sort of policy ambition, but it's an open question whether our implementation capacity matches our policy ambition, such that if we are going to impose these regulations on mining companies, if the mining companies do not enforce these, if the mining companies do not see these through, and the state fails to enforce them, then we're going to have the kinds of adverse negative impacts that we have. So yeah, that's what I'd add. Yeah.
All right, thanks a lot. I think, from all of your arguments, really what I'm picking up is, the state has to do sort of a very strong balance within its national priorities with investors, sequencing when it's time to sort of have a greater carry stake, and when it's time to sort of, have a carrot for the investors. But at the heart of all of this is, how do we ensure that the conversations I had with the communities that are most affected within the primary regions that will have this. I mean, it's easy to be in the capital city and making all of the decisions, but really it's sort of what's going to happen on the ground. And I think that for me is where the core argument is, that reaching that balance. I'm going to hand over to Dominic. I think you've got a couple of questions that you had set up.
Yeah, maybe just looking a bit more broadly on the beneficiation question and how you ensure compliance on it. And Alex, looking at the Africa Green Minerals Observatory and its role here, and is there a way to bring it more from a kind of jurisdiction by jurisdiction perspective to an overall African perspective?
Yeah, so some of you would have seen in the chat the link to the African Green Minerals Observatory. We've been very fortunate to have the opportunity to serve as a back-end technical partner supporting the African Union and the African Minerals Development Center, which is a specialized agency of the African Union working on the implementation of the African Mining Vision. In any event, to support them on this initiative called the African Green Minerals Observatory. Now, this partly stems from recognizing, number one, the incredible pace at which this broader debate and initiatives, both domestic African initiatives and initiatives from external powers seeking to partner with Africa, the pace at which this is proliferating, and the need to kind of enhance broader knowledge and understanding. Fundamentally, what it comes down to is recognizing, and we spoke earlier about regulatory risk or policy risk, the fact that policies do change, is that ultimately what a change in policy is an informed, hopefully, but a policy experiment. And countries across the continent, across the world really, but particularly in our continent, are grappling with these challenges that we've been discussing at this meeting today around managing domestic benefits, but also the risk of capital flight, the risk of losing your investors, thinking through ESG and the priorities around local value addition. So what that initiative does, it attempts to share broader knowledge where you can have mineral profiles, just an understanding of some of these key critical minerals: cobalt, graphite, lithium. Where do they exist on the continent? Where are they concentrated? Which countries? How does Africa's reserves of that mineral compare with global reserves? And then also look at the mineral profiles of particular countries. So you can look at a country profile like Tanzania or South Africa, DRC, and understand what the dynamics are there, and also some indication of the local processing initiatives that are underway. It does not go down to mine site level. It's also not a replacement for AMLA, the African Mineral Law Atlas. It focuses specifically on providing access to critical mineral or green mineral specific policies and regulations so that some of this comparative work can be done. And I think we have an opportunity for countries in the region to learn from each other. You know, we often use this phrase of a race to the bottom, and how the imbalance in terms of access to information, other forms of leverage, you know, that imbalance between often the state and the private sector. And we've got to find ways to address that, to learn from each other, and to promote learning as we move along. So that fundamentally is what the Observatory is about. And I really would encourage anyone in our audience who's not aware of the Observatory to please visit it. The link is in the chat. Adrian's been also working with us on the back end in terms of the content. Adrian, I don't know if there's something more you want to add on the Observatory?
Yes, I think part of the thinking behind the Observatory is to ensure that government policy around the development of critical minerals is informed by evidence as much as possible. And this is part of trying to avoid what I mentioned earlier, governments taking a knee-jerk reaction to this urgency around the need to extract and mine critical minerals. So it's supposed to act as a kind of repository to understand what's out there in terms of strategies, what's out there in terms of research, and it also has it has a news function as well that tracks sort of major developments as they relate to critical minerals. But I think part of what it also does is it helps to sort of improve the transparency around the African critical minerals debate, in the sense of, as Alex was mentioning, it gives mineral profiles, but country profiles as well. And so just from a sort of basic point of view of understanding, making strategies, documents, agreements around critical minerals more transparent, I think it also plays an important role. So it has this foresight, or sort of foresight role, in the sense that it should help governments to make sure their policy is more evidence informed, but it also just sort of plays a basic transparency function as well.
And Aaron, just jumping back to the earlier discussion on ESG, is there any way it can be used to help as a kind of ESG oversight tool?
I mean, that's a good question. I would say in its current form, no. I think that the African Green Mineral Observatory is in its early days. It's only been in existence for about a year, but there are plans to sort of look at second phase development, and that might be something we might look into for the observatory, bearing in mind that, as Alex mentioned, we don't wish to replicate platforms or initiatives that exist elsewhere, because then we'll simply be contributing to the problem that I mentioned earlier around the proliferation of various different ESG standards.
Yeah, I would add there that, you know, you hear sometimes this call for a critical minerals extractive industry transparency initiative, or a critical minerals Kimberley process. That's not what the observatory attempts to do. Because it plays that information role, look, it also, in terms of managing ambition, it doesn't pretend to list every news article or every major report that comes out dealing with critical minerals in Africa. But it does curate some of this information and tries to bring out the key messages and stories. And this would include reports by NGOs and other groups that are investigating social and environmental impact of mining operations, either at a country or a regional level. And maybe to a lesser extent, even the news function could highlight some concerns that come out. So it's not an accountability standard. But in terms of that information dissemination role, I do think that there is a link that can be drawn in terms of a more indirect supportive role.
Yes, I mean, I would just add on that point, Alex, that, for example, one of the things that's, amongst others, that's stored on the observatory is as far as is publicly available, the various memorandums of understanding that have been signed between different foreign powers and various African governments. MOUs around, so for example, the European Union has signed various MOUs with different African countries, and then there are those pertaining to the Lobito corridor, as well as the DRC-Zambia special economic zone. So it's important from a sort of, just from a civil society watchdog point of view, to understand what's in those agreements. Yes, they're MOUs. Yes, they're being struck on a bilateral basis, but it helps give you a window into the thinking of foreign investors into the continent, but it also helps us understand what is the continent doing in terms of exercising minerals diplomacy vis-a-vis other countries. Yeah.
Thanks, Adrian. And that's actually a good segue into our last segment, which is on exactly that, regional diplomacy and governance. And you know, the thinking that yes, Africa is made up of 54 countries, each with their own minerals, their own policies, and everything else. But ultimately, if we're all competing with each other, a lot of these minerals span borders. If we're competing with each other, and especially from a tax perspective, royalty perspective, how do you prevent that from undermining an individual country's value in its minerals? I don't know, Alex, Adrian, if you have thoughts on that.
I'd be quite curious to hear from Emmanuel his reflections on the Zambia DRC agreement, because that's, I mean, it's broadly accepted that regional value chains are going to be necessary, right? And I think this is something that's often missed. You know, I'm sure if the right capital and right incentives and skills development is brought to bear, Africa has the capacity to manufacture batteries, manufacture solar panels, and all the rest. There's a lot of talent and a lot of resources in the continent. But if you end up with a product that costs 3 or 4 times what it can be sourced from China, you have a problem. And putting up 300% tariff barriers is not as easy a solution as it sounds, because there are constraints to the domestic market. It is a question of who you're going to sell to. Again, that should please not be seen as a defense of the status quo, or to say that we can't intervene in this process, but to highlight some of the difficulties. And so one of the big advantages of China's production and dominance of the value chain is scale and efficiency. And the only way you're going to achieve that is through regional collaboration. And there's a lot of talk in the continent, going back to the African mining vision again, about regional value chains. But we find that, you know, it's one thing it slips off the tongue rather easily, but it's very hard to implement. Ultimately, that question of national interests and where the benefit lies and where the jobs are going to be created, where the factory is going to be built, you know, standard politics and contestation plays into that. You know, and it's not an easy question. You could say that, you know, for example, in our region in Southern Africa, South Africa has maybe the industrial base, some of the infrastructure, skills-based access to capital markets. That would mean that it would make sense, if you look at have a regional lens, for this manufacturing to be based in South Africa. But Zimbabwe is not going to be too pleased with that, nor will be Zambia or DRC. So, you know, when it gets down to the details, it becomes very hard actually to implement this idea of regional value chains. The closest we have to that at this stage is the agreement between the DRC and Zambia, and that hasn't been a smooth path. Am I right, Emmanuel? You're still muted.
Sorry, I thought I had unmuted. So yes, correct. It hasn't been a smooth path. And I think the challenge is always between, like, you can have the agreement in principle where Zambia and DRC want to do this, but then ultimately it comes to how do we actually implement it, as you've pointed out. And I think after signing the agreement, there is not really much on the ground which has actually happened. And the last thing which I actually read was the Minister of Commerce, Trade and Industry, who actually presented this to our parliament on the opportunity and what it actually presents for the government and for us and the DRC specifically. But then aside from that, we're not aware of much which has been done to actually actualize that electric vehicle battery initiative between us and the DRC.
I guess it's kind of like you said, Alex. It's, you know, we struggle enough on a general trade bloc perspective. In East Africa, we supposedly have free movement of goods and people, but I still get a visa requirement sometimes when I go down to Tanzania. You know, so unless you can get it right at the basic level, how are you going to get it right when there's millions of dollars of investment at stake?
But we must be careful, right? We must be careful because it's always easy to think of 100 reasons why things can't happen or why things can't change. And that's why I was trying to be quite clear that, you know, we've got to be very frank about the fact that the status quo is not acceptable. And so we do need to strategize around how we get there, but not pretend that that road is going to be easy. You know, I was very struck by, fortunately, I'm based down in Cape Town, where we have the Africa Mining Indaba every year. It's a huge gathering, biggest gathering of mining stakeholders on the continent. And, you know, we've seen that debate around local content and employment of local citizens evolve. You know, for the longest time, you had a similar kind of line of argument that just said, look, you know, foreign companies coming into Zambia or Mozambique, you know, we'd love to employ locally, we'd love to source locally, but the skills aren't there, the scale isn't there, the value chains aren't there, the quality isn't there, and that's the end of the discussion. But you've seen a massive evolution in that debate. And I was very struck at the latest Mining Indaba in terms of the reporting around the extremely high number of local citizens who are employed. And it's not enough anymore to just say that the skills are there. Then you have a responsibility to build that capacity. And it's not just at the lower levels, it's right up to senior levels in these operations. So change is possible. And we've got to be very, very clear about that, because I do think that these demands are legitimate.
I know we're running out of time, and I think that's actually probably a very good point to end on. The change is possible, and there is positive movement across the industry. I mean, that's very good to hear, Alex. I think maybe Rotendo, over to you for closing remarks.
Thanks, Dom. Yeah, I think that was a really nice sort of place to end, that there's definitely some progress which is taking place. And I think what will be critical is for us to have a look at where the changes have happened and what lessons we can take away from them. I think the key thing that is coming out here is the issue of scale, is the issue of capacity. And so the questions we should be taking forward and asking is, you know, how do we actually manage to increase that scale, and how do we actually manage to increase the capacity, you know, such that it becomes a much more fair competition, if I can put it that way. But otherwise, in terms of closing, I just want to firstly thank all of the speakers who have joined us today from, you know, sort of South Africa, the South African Institute of International Affairs, as well as the various ALN member families, ALN Kenya, ALN Tanzania, and ALN Zambia. I think we've got a really good geographical spread here. Like I said, if there's anything about regional collaboration, we did it. And then lastly, I just want, you know, us to continue the conversation. So please, I don't know, Victor, if you can share with us QR code. We want to get all of your questions. Please do send all of your questions. We're still in the mood for answering them. I've got an upcoming webinar as well on what's happening in terms of public finance and expenditures in Africa. So be on the lookout for that. And we also have an energy webinar that's coming up with the Africa Policy Research Institute. So we're really looking forward to seeing you again. Adrian, was that your hand that I saw up?
Yes, I just wanted to, on behalf of the panelists, also thank yourself, Rotendo, for bringing this discussion together. It's much appreciated.
100%. Thanks so much. Thank you so much. Okay, so of course, as my age and generation say on YouTube, like, share, subscribe, and please keep following all of the stuff that we're doing. Thanks, everybody. Let's continue this conversation online, offline, and have a wonderful evening, everyone.
Thank you very much.
Bye. Thank you.
Thank you. Bye-bye.
Thank you. Bye.